How's money approaching India at this point, Sanjeev, especially given those macro points you just made? I mean, what would the approach to a market like India be, where earnings performance has been so poor, added to which there's probably some kind of rate pressure looming?
Well, honestly, as far as FI investors are concerned, India is not a market that is on the focus anymore. It is, one more emerging market which is struggling with a pretty large current account deficit. So effectively, look at what has happened in India in the last 8-9 years. So from a special place in the hearts and minds of foreign investors, it was an asset class by itself. We moved to a favored emerging market, and now we have moved to a situation where, honestly, investors really don't care that much about India, given its macro problems. So the interest is confined to a narrow band of, maybe 50 stocks. So you have a very peculiar situation in the Indian market. You have effectively a three-tier market. You have, the top tier where you have your consumer staples, pharma, and some of the top names in a few sectors. And those companies are trading at rather ridiculous valuation, or pretty expensive, I would say. I mean, long term, these are great companies, but how much do you want to pay for them for the next 2-3 years? Then you have a middle of the road, stocks in the auto, energy, maybe telecoms and regulated utilities, which are trading at, I would say, more fair valuations. And then you have the rest of the market, which honestly nobody cares about. So it's a pretty peculiar market. And if you look at this composition, where would money go in that case? I mean, are you willing to buy a lever at 40p? The answer is no. Are you looking to put money in the middle of the road names where, things are looking reasonably fairly valued, and you have a lot of issues on the growth issues over there? And the third lot, I think they are all priced to bankruptcy at this point in time, and probably some of them will go bankrupt looking at the situation over there. So I don't think you can see money coming into this kind of a market unless until you start seeing some clarity emerging in some of the sectors. Some of the sectors, like for example energy, can absorb a lot of money, but then the government has to give some clarity on the subsidy sharing, etc. I mean, there have been some reforms done, but nobody knows what is the net benefit to the companies because of deregulation on diesel pricing or higher gas prices, etc. Same way on the telecom side, again the sector can absorb a large amount of money, but there is a lot of uncertainty on the regulatory framework in terms of spectrum pricing, etc. So if you start giving some clarity, I think you can see some amount of money moving from the traditional favorites to more a broad-based bunch of stocks, and that can really help this market, because this kind of a weird market, I don't think you will see money coming in. The favored names are too expensive, and the rest of the market nobody honestly cares about.
Some news flashing on your screen. The Finance Ministry is apparently looking into LIC's investments in Gitanjali Gems. So that's an interesting one. Tat LIC. How could they look beyond the galaxy of beautiful government companies which have been offered every week, every month, and look beyond that to a private company? Shame. So let's see what comes out of that inquiry. But the market has lost a little bit of ground now, up 10 or 12 points at 59.20. Sanjeev, when the dust settles on the currency, even if that gets pulled back into a bit of a range for the moment, what happens to growth? Do you think the next 3-4 months, as we wait deeper into the year, people may suddenly realize that we may have another year of 5% GDP growth, not this 6.5% that the government is talking about?
I think if we get to 5%, we should consider ourselves lucky. I think, economists are generally smoking dope as far as GDP numbers are concerned. And every year you start with high numbers and then cut it back to, some, lower numbers. So I don't know where this optimism is honestly coming from, because you have a dead investment or capex cycle. You are seeing numbers as far as, the consumer discretionary sector is concerned, negative numbers over there. So I'm not too sure where this growth is going to come from. Yes, maybe monsoons are good, so that will result in maybe agriculture GDP growth being slightly higher than what we have seen last year. Maybe low 2%, low 2% over there, and you will get some stimulus to the economy. Once you are headed closer to elections, whether it is official spending or unofficial political related spending. But that's about it. Beyond that, I am not too sure what is the driver for this economy at this point in time. My bigger worry is actually 2015. I mean, there's a lot of hope that we'll get to 7% over there. I think we will be lucky if we were managing 5.5% for 2015. And the simple point is, if we don't fix the capex cycle now, 2015 capex numbers are going to be even worse than what we are going to see in 2014. And given the fact that we still don't have any clarity on many of the sectors in terms of the regulatory environment, I'm not too sure why investment will flow in over there. I mean, no new projects are being launched, so whatever capex you are seeing currently is basically coming from projects that started earlier and which are now getting complete. So I think 2015 is also going to be a washout unless and until we start fixing problems ASAP. One of the things we need to definitely implement is the GST from 1st of April 2014. Otherwise, even the next financial is going to look pretty dire, I would think.
Well put, Sanjeev, and if the economists are smoking dope, I wonder what the policy makers are on. So that really makes things interesting for the next 6 months or so. Have you guys translated all this into a market target, Sanjeev? Because, you know, that's the weird part of it. I mean, everyone can see what the problems are, and the problems are large, but the market hasn't corrected in conjunction with that.
Well, you know, there is still some hope. I mean, the arguments which I get from investors is somewhat fallacious, but you know, you can see some merit over there. So the argument goes as follows. You know, number one argument is India looks better among emerging markets, and especially the larger emerging markets. On the one side, you have Brazil, China, Russia, which look worse than we do, and even South Africa and Turkey also running pretty large current account deficit. So India, in that context, among the larger markets, looks okay. Versus Southeast Asian countries, you know, we may look cheaper, but those countries are doing better in terms of, you know, GDP growth, but they are much more expensive now. So India in that way stands out among the emerging markets, you know, for whatever it is worth. The second argument I get is India is a great long-term story. So even if you are, you know, overpaying for some stocks over here, that's fine, we'll continue to stay invested. You know, the big worry is at some point in time, a lot of investors are going to start wondering whether this whole emerging market thing makes any sense for them, and whether they should start pulling out money from emerging markets as a fact, which we have started to see happen in the month of June, you know, because developed markets have done far better in the last 5 years compared to most emerging markets, especially on currency adjusted terms. And then people will start questioning, you know, what are we into these markets for? It doesn't make sense to take so much of currency risk, etc. And, you know, with now emerging markets effectively adjusting to a much lower growth profile, does it make sense to be, you know, to be invested that much in the emerging market space? So that is a much bigger worry with emerging markets, and within that India will have to contend with. Also keep in mind the fact at some point in time you will start seeing the US Fed starting its tapering of the bond buyback program. What does it mean for capital flows to emerging markets, and particularly emerging markets will run very large amounts of current account deficit? That is going to be a big pressure point. What happens to the currencies then is a big question mark. And I think we should be prepared for a fair amount of volatility whenever that process starts, maybe towards the end of this year. If things, you know, start picking with economy, in the US economy, it could even happen earlier as far as India is concerned.
So many question marks, so many exclamation marks, Sanjeev. Thanks for joining in today. Good to hear your thoughts. Thank you.
My pleasure.